Samir Arora joins us now, and every time I know Samir is joining us, we should get ready for some gupshup, right, sir?
Absolutely. गपशप तो शुरू का वो है.
How you been, my friend? Long time.
Yes, I've been enjoying myself and markets have been okay. So everything is good.
Everybody is saying valuations are expensive, the markets are due for a correction, but look at the ability of the market to shrug off bad news. What it did on the election day, what it did on the budget day, what it has done post that Black Monday, which happened 10 days ago.
Correct. So, the thing is ki one of course is flows, but it would look out of place if we were doing it independent of the world. So basically the mothership, which is US, is also doing the same, not related to the budget or elections, but in general reacting to any bad phases. And so it has recovered so well. Japan has recovered, तो फिर हम क्या लड़ाई करें? Except that you can see that the FII flows have been quite negative. And I think that is because these tax hikes have become untenable. So just to give you one number, the MSCI India index in dollar terms is up 17 point some percent year to date, whereas the ETF called INDA, which is a $10 billion index, is up like 13%. So itna farak jo hai over time, this is going to pain and there will be some loss over time of FII investments into India, I think.
Samir, so one side is this concern which everyone has about FNO participation, valuations, and on the other side you've got flows which are predictable, which are easy to understand, and you have stability there. So which
You
side
know,
do you think has a greater argument right now?
But may I just say कि थोड़ा उसमें भी twist हो रहा है life में, which is that we keep, because now we are in the mutual fund industry, we keep being shown these very high SIP flows. And I was telling Dinshaw यार कि हमारा market share बड़ा कम है. And then we realize that actual flows are only half of that. So that is, I don't know why collectively as an industry and as a country, we are deliberately only putting out half the information and the other half is in a footnote, that the actual net flows are not some 20,000 crores or whatever per month. They are only 10,000. So ये पता नहीं क्यों why we have all arrived at this that we will talk about gross flows. So net is good, but I want to say that so that we don't have this question कि we don't need FIIs, हमारे तो domestic funds will take care of us till we reach the moon. The point is they are good numbers, but they are not what you think are numbers.
Okay. So Samir, then why is this market holding on? I mean, if flows are net, yeah, I mean, flows are, let's say,
They're
gross.
still good. They are still good. They are still good and they are quite regular. So that way it is steady and good. And as I said, इसका क्या होता है कि if at some point if we say why we are not bothered, then one day you will bother so much that it will, because we have seen it in the past. So therefore I'm always in my camp where I have stopped being outright bullish on anything. I suffered a lot for that in 2008, thinking that we are God's gift to the stock market or to mankind or whatever. वो ऐसे नहीं होता है. But when it is doing well, we are all participating. But थोड़ा control and restraint होना चाहिए. But secondly, we cannot let go of pockets of flows by just believing ourselves that we are getting 20,000 crores a month. So how can anybody stop us, kind of thing? When things go bad, they will become very bad if we ignore one big pool of money and more than that, ignore valuations and ignore bad news beyond a point. So वो थोड़ा balance करना पड़ता है. We have also done it. I'm sure fund managers are doing it, but as a market, although you can see some correction in mid cap and small cap. Yesterday, I saw a report from, I think, Motilal Oswal that the what was it, mid cap earnings are up some 5% in this first quarter, and for small caps, I think they are down or vice versa. So, कुछ तो balance होना चाहिए, which if it doesn't happen now, it will happen with a vengeance later. But you cannot escape all those things over time. It doesn't mean today we are feeling good or bad, but I still feel bad that we are not appreciating what these tax rates are doing to global flows into India or will do.
So, Samir,
And by the
then
way, now we are ourselves both mutual fund and FII. So beyond a point, it is not me telling my book and all that, because our mutual fund flows are doing whatever they can do considering our size. But I'm just saying, as a India observer for 30 years, that please call 5 serious fund managers. Don't call custodians and don't call these trustees who don't care. Call fund management companies and ask them what it means, if what these taxes mean.
Okay, fair enough, Samir. Let's also understand that, rule book that you guys go by, you're identifying what not to buy in a market first up before you take the plunge and decide what to buy. So what makes that list, if you could walk us through it?
What makes the list of what not to buy?
What not to buy? What is it that you're avoiding in this market?
For that broadly, we have, so what we figured out over time was that if you look at a 1 to 3 year period, the number of stocks that do better than the index are approximately half, and the stocks that do worse than the index are approximately half. It is very different from what people have a feeling that only 10-20% of stock create wealth and really outperform the market. That is true, and that is what happens over 10 and 20 years, when you may find that only 2 banks did very well, which is Kotak and HDFC, and 10 did badly, or 5 tech companies did well, and actually 100 started. But just because of an arithmetic angle, which is that the index is an average return of 500 stocks, some half do better, half do worse. So the first thing to reduce the probability of doing badly, or in some sense to improve the probability of getting winners, we have figured out that it is easier to know what is bad than to know what is good. Because to know something is bad, you need even only one factor is enough. For example, if I say that a stock is very expensive, that is normally enough to say we are not buying it. But if you say a stock is not expensive, then somebody might say, so what is the value of that? How's the management? Or how? If I say that the management, according to me, has a very bad history of corporate governance, normally you need not ask me what is the business. Because if you agree with me that what I'm saying is right, and that is enough. So we found that it is easier to reject, because rejection can be done with 1 or 2 factors. Whereas to say positively that it's good stock, you will say, but what about management? And I'll say management is okay. What about history? Then you say, what about strategy? But if I say one of those things is bad, then that is enough to reject. So that is why we started with the rejection, this thing some 10, 15 years ago. And these 8 factors are there, which is history, industry, theme, valuations, corporate governance, next to 3 year financials, etc. And on that basis, we are first rejecting if it doesn't fit even one of these factors. And that is why we have sold many of these companies, which on every angle are good, except that they get rejected on very high valuations. And you know what they are, because I've been talking about them for 2-3 years, and broadly we've been right on those. So that is the way. For the rest, you can see my presentation pinned on my Twitter account or go to our YouTube channel.
Samir, morning. Now that you're back, all refreshed from Paris Olympics, I want to talk to you about a point that you made very interestingly, but small part of it, that broader markets are actually correct. The index is just 5% lower, but the small and mid caps are in many cases 20-30%. A silent stealth correction is already happening out there, and these are the stocks which are mostly owned in India by HNIs, big HNIs, or even retail for that matter. The narrative now is that we are staring at a tough next 12 months because there are no big triggers out there. Earnings are not really wow, and we could be heading to a correction. So what's the right strategy to book out of residual gains?
So first thing is, what we are doing is we are trying to, even now we try to buy mid cap, small caps, not that we all stop. We want guaranteed, it have mine not guaranteed, but very high confidence, 20% earnings growth, revenue growth, for which we are willing to pay a bit more. But in general, it is difficult to find companies on aggregate growing 20%. So, therefore, if the earnings don't grow 20%, your stock prices cannot grow 20% like they have done in the past, because there in the past it has been a combination of earnings growth plus some re-rating, revaluing because of flows or whatever, or interest. So now you want that. Now you will say, oh, but your HDFC Bank, which is your top holding, does not grow 20%. I totally agree. So we have again these two kinds of stocks where we feel that the confidence is high that you'll make reasonable money. And then I'm talking about these new ideas if you want to buy. Otherwise, we'll buy just more of the same. And that is the only way to do it, because overall aggregate market is not going to grow 20% anymore, and neither will the stock prices grow 20% anymore, because now you have to grow with earnings, because the rating part is more or less over.
Will that hold true for, let's say, PSUs also? I mean, PSU stocks at best will grow at 15-20%. I'm talking about earnings here, right? Because these are like single digit or early double digit margin businesses. If the economy is growing at 12-13% nominal GDP, then these businesses will grow at 15 to 18%.
True. So some of these things, we used to, for example, I've said in the past, I think from my budget day or whatever, that's like these railway stocks. Now, these railway stocks, we were at that time, now we don't have, but we had this thing that, oh, Vande Bharat will come and these guys will sell food and the other guy will sell rake. And then after a few days, you realize that now the Vande Bharat orders are being cancelled because the government has rightly, or at least based on feedback from this thing, thought that they should rather invest money on tracks and on security and on safety and maybe on non-air conditioned coaches and trains and things like that. So all these things change so much in the market when the expectations are very high. That is where the disappointment also is very high if it doesn't happen. So now the PSU as a general theme, I think that part is over. Now, if you like a company, you buy it at whatever 10, 15, 20% growth rate, but this thematically that PSUs will outperform normal private companies because ABC is happening. I think that part is over. That doesn't mean they are bad. By the way, I have one difference with the world also, that many people say the market is fairly valued or a stock is fairly valued. I don't mind fairly valued things. I don't think all your life you can get undervalued things. If you get fairly valued things, that means you are only going to make returns out of the earnings growth. So earnings growth, if it is good, say 15-ish% in this environment, then that is actually not bad. As I said, we're trying for 20% growth for new ideas, but it is very difficult. But fairly valued is also okay. So I would think big picture plus minus, they may be fairly valued, but they are definitely not pockets saying that, to outperform by this group.
Samir, everyone likes private banks and everybody is of the view that ye trade का भी समय आएगा. What is the biggest restrictive factor for private banks now?
नहीं, अब क्या होता है, this is all momentum, because the story can be changed in 20 seconds. For example, 2-3 days ago it came that Morgan Stanley has done this in 2 steps instead of 1 step. Now, separately, to understand, it is guaranteed that the second step will happen in November. Why? Because they said that if the room is less than 20%, then it won't be. But for that, you will need to buy some $6-7 billion of the stock to make that FII capacity less than 20%, because of which MSCI then does not increase the weight second time. But that means anyway, what you are hoping to get from a weight increase would have happened on its own. So what I mean is, how would it have mattered so much other than to a pure short-term guy who was borrowing money or God knows what it was, that in a 3-month period, it is guaranteed to happen what you thought will happen this month end. And for that, you hit a stock 4%. That's quite a lot in a market which is otherwise bullish. So this is, this is called momentum, which can happen in both directions. But it's not that we are thinking that HDFC Bank is going to grow 20%, but it'll still grow 13, 14. I don't know. But what I'm saying is time will come, just like everything which is massively overvalued corrects for whatever random reason. It could be some you don't like US investor borrowing in yen and investing in dollar, and you can hit a market down. Those excuses will come later in both directions.
Right. Samir, since you understand lenders so well, you've been right from the evolution of the large lending institutions. What are you making of the bombing out numbers some of the unsecured lenders are showing?
MFI guys,
even MFIs, and even the sections of large banks which have good MFI exposure, Nikunj and I were just talking about one of them, they got challenged this quarter, IDFC Bank. How, is it bottom of the cycle for this pocket or can't say yet?
No, we are not thinking it is bottom. So we have also reduced one of these if you see our disclosures. The thing is that the MFI sector works for 5 years in a 7-year cycle, and then 2 years you do very badly. And we all thought that it is not happening right now, but when it happens, it is quite generally bad in some sense. And you saw that in the fusion or whatever results also. We are not thinking it's a bottom for to be bought right now.
Samir, so let's look at if today is the starting point, which is 16th of August 2024. For next 3 years, is equity as an asset class in for double-digit returns, or that also would be a challenge?
No, I don't think that will be a challenge. As I said, I am not thinking that we should be looking at a market only if it is deeply undervalued. Because if you see all these guys who write books and make big presentations will say, the market was doing badly, and in 2008 October I got money from some clients and I invested, or somebody will say I was very bold during COVID times and I bought it. But real life does not work that you wait for absolute crashes, because first of all, the crashes work for only say 6 months in a 5-year cycle. Of course, those 6 months are very bad, or 1 year is very bad. At that time, mostly at least in the fund management industry, most of the time the client is also scared and doesn't give you money. And in any case, that is not the only way you can make money. So the general way is that if it is fairly valued also, it is not bad, because then you are trying to get earning growth, and earnings growth maybe of the market does not grow even 10-12%, but then you'll say, oh, exclude these 2 oil companies, exclude this 1 steel company, exclude these 4 some other companies, and the rest of the market will still have earnings growth, I think more than 14-15%. It is that for some of them, you will say that no, but the valuations are 60 times and 70 times. So what to do with these kind of valuations? You have seen that valuations matter a lot. Of course, you saw it with funds, but more than that, say a company like DMart, you saw how it grew its earnings, but nobody cared for 3 years. So these things happen all the time. So you are just, that's why I like my elimination model, that you eliminate the extreme cases of poor growth, the extreme cases of poor history, the extreme cases of poor valuation, which means high valuations, and extreme cases of industries which are absolutely not in your control. For example, I totally don't like the idea of these auto guys, because it is absolutely conceptually wrong. Now you can push it, I don't care, but I know that half the market will outperform the market. So if I eliminate only the extreme cases, I will not be eliminating 250 companies out of 500. Maybe I'll eliminate like this 100 companies out of 500. And therefore, in theory, if I'm trying to buy 40 companies, I still have 100, 150 potential companies from which I can try and get. Now, I won't get all of them in that half, but if I can get a large part, then I am done. So I am just eliminating the obvious. It does not mean that they will do badly, but I don't care about the companies I don't buy. I only care about the companies that I buy, that they should not do badly. I care less that a company I did not buy has done well, because half the market is going to, in theory, as far as I am concerned, do well, because my benchmark is the index. I want to beat the index, and that is what.
When we spoke to you about 2 years ago, your view was that you've gone zero on IT.
Yes.
And that time the logic was that stocks were trading above their historical averages and the business was contracting.
So business was not contracting, because we are talking about 22, but that the interest rates had started to be increased, and there had been that Ukraine war, and basically the S&P 500 earnings were not supposed to grow because the interest rate hike was so much. But in the last 2 years, so they have done actually well. No, they haven't done well, but broadly they have not made me obscene amount of money. But I mean, by shorting, even because we had short also many of them at that time. But we made money because that money was used somewhere else. So it is not that those stocks did very badly for whatever bullish reasons of our market. But you have $100 and we used to have 15% of that in IT, and not having it in IT other than one stock and having that 12% in some other stocks helped. But now, after this correction and after this thing, today we have around, I think, 7% in IT. So we are no longer zero. We have not been for the last 2 months.
If somebody has to invest for next 3-4 years the Samir Arora way, which is that you like to buy companies which essentially are concentrated in and around mega trends, you like to buy what is new, you like to buy exporters, you've shied away from very, competitive businesses, where are the spots?
So as I said, actually our model does not say buy concentrated, because we are strong believers that you actually exactly don't know whose turn it is next. But that in aggregate, a large number of companies do well. That actually, if you see in our presentations, that not one fund manager in India, which includes me also, beats even the returns that the 150th best stock of the index delivers each year. Separate. I mean, every year there'll be a separate different stock. But you can't even beat the performance of the 150th best stock, not of the market, of the index. I'm talking about the 500 index. It's not easy to beat the performance that say, broadly speaking, once in a while you may, but 30%, 30% means 1 to 30%. आप rank में करें 500 stocks in terms of performance, you can't easily beat the performance of the 150th stock, because the 150th stock is beating the market on average by 10-15% in a year. Every year, of course, it is different. Point being that so many stocks do well that there is no need to be overly concentrated. Therefore, I don't do what you're saying about. I'm saying you should cover your angles a little bit. Many times when the PSU started doing well, and we never used to own them other than the State Bank of India, and maybe we had Bharat Electronics, we said, no, there is some logic. There is some logic to PSU doing well, because the government is, going after these guys in terms of saying, do better, putting pressure. The value at that time, the value stocks were doing well. We did not have enough of value stocks. So we said, let's find. It was not that not one line can be justified. Sometimes when we don't like commodities, but let's say somebody comes up with a story that China is doing well and there is some strike somewhere and something has happened somewhere, you can buy one commodity company. There's nothing wrong with it. But most of the times, 90% of the time, we will not buy all these things. But once in a while, you can buy it for 5, 7, 2%. It doesn't matter. You are not to add value on 100% of the stocks. Some 3-5% might be more to cover yourself, might be more because it looks okay from some angle, but we don't have a history of doing well there. And we can try and add value on the 90% and neutralize the 10%, if it makes sense. Rather than every day worrying, oh, this stock is doing well, but we don't like it for our reasons. And our reasons are also, in some sense, qualitative, that we never liked PSU management, but we used to own what we liked, which was, say, State Bank, or at one point, even till today, but at that point, Bharat Electronics, whatever. So these things are not to be cast in absolute this thing. I see many presentations that I like companies which grow at 15%, say EPS, and some 18% ROE or 15% ROE. But nobody asks them, but I do, then what if the earnings growth is 14.5%? What will you do? So these things are all directions.
Right, Samir, have a good day ahead. Thanks very much for your time today.
Thank you.
If you like this video, then like, share and subscribe to ET Now.